Go ahead and get started here. Welcome everyone to the third growth option workshop number 2. We'll do a quick recap of the introduction from part 1. You can see the details on the recording, and then we'll really spend the majority of this webinar on a couple of case studies where the third growth option was used to help expand the market footprint of 2 different companies by adding new adjacent product categories. So my name is Benno Dunkelsbühler. I am the founder, CEO, and Chief Sherpa of Realign. And why did we use the word Sherpa? Because we work with owners and executives to help them reach the next mountaintop in terms of new markets, new categories, new channels. Just a quick housekeeping detail, if I could ask everybody to just mute yourself so we don't get echo. And I want you to stop me whenever ask me questions whenever throughout the webinar by just using the chat box, and I'll keep an eye on the chat box. So as you have questions, just type them into the chat, and I'll respond to that. Okay. So just to make it a little bit easier to follow, I'm going to turn off my video so we can just look at the screen together, so we don't have too much distraction there. Okay. So primary goal here is to just share an approach to growth that is really faster than internal organic growth and cheaper, less risky than acquisition. And I really want to provoke some new thinking, and maybe you guys have been thinking about some growth initiatives, and hopefully this will get you to re-engage in those growth initiatives. And then secondarily, I do want this webinar to be a little bit less formal than earlier webinars, so the more interaction, the better. So the third growth option is really a cross-functional growth approach that helps whether you're in slow growth or fast growth, right? If you're in a slow growth situation, you need to create growth. In a fast growth, you need to manage growth. So on this slide, we have on the left hand, we have this before and after third growth option example of actually the same company. So on the left side, they had experienced 3 years of stagnant sales, shrinking margins, so the valuation of the company was shrinking. They didn't really make growth investments. And then on the right side is the sort of after the third growth evaluation, where sales took off very significantly. There was a little bit of a growth investment, but the valuation of the company rose faster than the growth investment. So it was a good return on the investment. The third growth option really, it helps both to create growth and to manage growth, because the third growth option is about building new categories or new channels of distribution, or a better go-to-market process in the core categories and channels, right? The real problem that this third growth option helps to address is that you cannot run a business and build a business at the same time with the same resources. So just a quick introduction. I'm not going to go through my chronological milestones of my career, but just sort of concepts I picked up in my 30-year career in the home decor and gift industry. I was born and schooled overseas, and in the 1970s, I watched my dad crash from nice financial success to being really painfully stuck for about a decade, and that lack of revenue generating clients really shaped me, right? I was watching my dad struggle through that as when I was a teenager, and when I was 16, my dad uprooted us. We moved from Germany to the United States, to a farm 12 miles from the next traffic light. And I watched my dad get unstuck and build a business that ended up selling organic product to five-star restaurants. It's another story for another day. But all of us have been stuck at different times in our life and our career or our business, our entrepreneurial journey. So we can only grow if we face reality when we're stuck and face the reality to get unstuck. My journey to America as a teenager helped me visualize kind of that difference between being stuck and no growth and unstuck with a passion for delivering value, more value to more clients. So this idea of growth mindset is something I've been thinking about a lot. I kind of divide, or an easy way to think about it is to divide the world into conservative mindsets and growth mindsets. I respect the first one, of course. It's good to conserve resources, right? But I'm really passionate about the second, that growth mindset. And as you consider this third growth option, make sure that it's being led by somebody with a growth mindset. I think that's super important. Just to give you a little bit more of my background, so I learned the ropes as a merchant and marketer. First decade of my career with Pottery Barn and IKEA, and then where I was sort of a corporate rebel, and I climbed from that to being head merchant and then CEO and private equity owned businesses in the second decade. And then I started Realign Growth Agency in 2009. Got to work and travel all over, lots of countries and continents, lots of factory relationships in Asia and Europe, and then my share of trend shopping and funner places like London and Paris. But and then in the early 2000s, I started to take on turnaround challenges, either rebranding, turnaround challenges or rebranding challenges of mid-sized distributors, many of them PE-owned companies. So the common thread in my journey is growing and expanding horizons and collaborating with people and teams in different locations and countries to make growth happen. So collaboration is key to growing and is key to the third growth option. So I don't see any questions yet. So we'll kind of get into the heart of things here. So what we're going to talk about for this in this webinar, we'll do a recap from webinar 1 on what is the third growth option, a recap on what is a Sherpa and how can he or she help with the third growth option, go through some process optimizers and the growth evaluation process. And then the bulk of it really will be 2 case studies. All the people and process descriptions, is important foundation, but at the end, case studies is sort of where the rubber meets the road, and hopefully you guys will get some ideas by looking at these case studies together. Again, stop me anytime by just jotting a question or a hi or a wave in the chat box. We want to make this as interactive as possible. All right, so the third growth option. We're taught to think about growth as sort of a binary choice, right, between organic growth or acquisition. And organic growth, what on the slide here I have as option 1, organic growth is you're running and optimizing the business to organically grow it by optimizing sales and sales management, optimizing product, optimizing operations, finance, etc. But and that organic growth that comes from optimizing the core business is very, very different from growing through acquisition. There, in acquisition, you're buying or acquiring access to markets and to capabilities, and then you're trying to buy it as cheaply as possible, of course, and integrating it into your business. But there is a third option, right? That's what we're talking about here today. And the third option is it's faster than internal organic growth, and it's cheaper, much less risky than acquisition, because this is the option of building new categories, new channels of distribution, or developing a better go-to-market process for the core business. So how do you approach or how do you implement this third growth option approach? It comes down to people and processes, right? And when we're talking about people, when I introduced myself at the beginning of the call, I said, hey, we help owners and executives reach the next mountaintop, right? We're Sherpas. So the Sherpa image just kind of made sense to describe the people and the process for third growth option. Building access to new markets, it is a lot like climbing Mount Everest, and you'd probably never hire a consultant to climb up Mount Everest with you, or a VP of sales, or a VP of product, or a VP of operations. You'd hire a Sherpa. So what is a Sherpa? Sherpa is an expert in their native area. They guide teams of climbers and help you to reach otherwise unobtainable summits. When you're looking to bring a Sherpa in to drive this third growth option in your business, what kind of experience are you looking for? You're really looking for a mid or late career level person, somebody with 15, 20, 30 years of experience. You're looking for an ownership mentality, somebody who thinks like an owner. From a functional background, I think background in sales, marketing, operations are the best backgrounds in terms of experience. From how they think perspective, DNA perspective, that was the word I was looking for. You're looking for somebody who's hungry, persistent, gritty, who shows grace under pressure and remains curious under pressure. So you're looking for somebody who is able to both work independently and as a team player. You're looking for people who thrive in changing and challenging environments, right? The responsibilities of a Sherpa are to create strategy, not waiting for others to guide them. It's important. The responsibility of a Sherpa is to facilitate meetings and engage stakeholders. And then they've got to be able to both multitask and execute. This is all about execution, right? So you might already have a Sherpa on your team, and that you look at this description, and hopefully that helped for you to identify a Sherpa. If not, obviously we can help you find one. So we said it's people and process. Here are 3 process optimizers for the third growth option. Again, we covered this in more detail in webinar 1, a recording of which is available on the Realigned website, which it's realign4results.com/blog. So the first process, just defining whether you're playing in a core business, what is your core, your existing core business, or in a new business. The bottom left side of the bottom left quadrant here, it's core category, core channel. The top right quadrant, it's new category, new channel, and then the other two quadrants, it's either core category, new channel, or new category, core channel. So be very intentional about what quadrant you're playing in. Secondly, criteria we use to validate a growth opportunity. We use the SEE acronym, which simply stands for size of market, ease of entry, and ease of execution. Think about each of those three things, and small or large, easy or hard are not necessarily, it's not about one or the other, but sometimes it's good to be a big player in a small market. Sometimes it's good if it's not easy to enter a market, not easy for others, maybe easy for you. And then thirdly, a process around organizing a third growth option project. We think about it in terms of define, refine, scale. Again, we go into that in quite a bit of detail in webinar 1, but the short point is you need all three. We've all heard of the statistic that something like 85% of startups fail in the first 5 years. I think the same is true for internal startups, which is basically what the third growth option is about. And I believe startups or internal startups fail so much because people do only one or two of these three things well, of the define, refine, scale. Last but not least of this recap, the growth evaluation. This is really where you're taking the leap. You've been thinking about a growth opportunity, wondering, sort of kicking the tires on it, wondering whether it's a good idea or whether it has merit or not, how much of an investment would be required to make it happen. I strongly recommend that any significant growth initiative has to start with a growth evaluation. And the way I think about a growth evaluation is you're evaluating all the parts that are shown here on this pyramid, right? All the parts of a go-to-market process and operational processes, from the unique value proposition as a foundation, to internal processes, to the kinds of sales tools that are required to go after a specific market. How is that market defined? So the first part of a growth evaluation is to ask a lot of questions around all of these. We have a list of 40 plus questions that we ask to understand the business from this perspective. And so in the beginning of a growth evaluation, it's just about looking, listening, and learning. You want to take a good amount of time. You don't want to rush through it in a couple hours. You don't want to agonize over months. I recommend taking 4 or 5 days over a couple of weeks long period to dig in, and take half of that time for input, where you're asking all the questions from the prior slide, and then take the other half of the time for output, where you want to write down answers to these in these 3 bullet points that I have here. You want to assess the current situation. That's where you're kind of writing down the good, the bad, and the ugly. Answers to the previous slide's questions. That's really important for alignment, right? If you don't agree on the situation, you're not going to agree on the solutions. Secondly, define the opportunity. And it's when defining the growth opportunity, both sort of qualitatively and quantitatively, it's really important that you name the revenue goal, because unless you write down, I believe I can add $5 million or $25 million worth of revenue by doing these things. And here's how I came up with this revenue goal. You're not going to be able to know how much how much of an investment is a reasonable investment to make. Third and final part of the growth evaluation is a list of the activities or the deliverables that are required to turn the opportunity into reality. What I call the W's, right? The who, what, when, where, how are things going to get done? Does anybody have questions? So this was just sort of the recap of what we had covered in webinar 1. Wanted to get everybody up to speed on that. Any questions that you'd like to throw into the chat box? All right, keep my eye out for that. And let's jump into the first case study. So this was a third growth option example where we added an adjacent new category. It happened to be for Department 56, a division of Enesco. And it was a fairly quick 10-month project. And I say quick because it was also a very comprehensive sort of A through Z turnkey project. We assembled a 5-person Sherpa team, part-time, and got Department 56 into a new adjacent category. So what was the situation? They had hit a growth ceiling. They needed counter-cyclical businesses. Department 56 is a fourth quarter seasonal vendor. And the team did not have the bandwidth to build a new business, right? To build a new counter-cyclical business. And Department 56, part of Enesco, owned by private equity, so there were private equity pressures on that. Because no bandwidth, there was no product strategy for the new product. There was no product pipeline. There was no sourcing base. Now you might have a different situation. You might have a similar assortment project idea, but it might be due to the tariff situation, for example, right? Certain categories that you've been buying out of China, you're now trying to get it out of Vietnam or Cambodia or India, but turns out that Vietnam can't do it the same way China does it, so you kind of need to tweak and maybe redevelop, add a new category for that reason. Or e-commerce realities might force you to add a new category. So here's how this growth story happened, and I hopefully there's a process here for you as you're thinking about a third growth option. So it's a pretty logical progression, right? We're starting up here with the growth evaluation, look, listen, learn, define the prize, assemble the team. Then you go into market research, you're studying the competition, you're coming up with a concept, you develop the concept. Obviously, you're only looking at the relevant competition, and then you're looking for a market gap, or what I like to call, you're looking for a gap in the market and then a market in that gap. And then thirdly, down here, you're developing concepts, you're developing a SKU framework. And that's sort of a left brain and right brain exercise. You have, left brain Excel sheets that, for assortment plans, how, number of SKUs, price points of items, gross margin percentages, all of that is very left brain Excel sheet, very important. You need to have right brain visualization of this concept, the look and the feel and the Pantones and, the fonts or what have you. What is it going to look like? And then the fourth item is where you get into developing sketches and sample specs. In this case, it was, over 500 sketches that turned into 200 some specs, samples that could then be launched. So we had 5 people, 3 designers, a marketing person, and a sourcing manager / project manager that coordinated all this activity that you're looking at here. And this is what it looked like, or what some of it looked like. Again, the big error here is sort of the big story from research to concept to market launch. But the market research begot a concept, and this is just one of 30 different concept pages that we had done for that project. From the concept, we could do factory selection. Actually, it was the concept and the competitive pricing got us help with factory selection. Concept begot sketches. Sketches begot specs, and specs begot the catalog and the final launch of the catalog and the launch of the product. So the main activities that we had to do in this third growth option case study, we had to assemble a seasoned offsite team of product designers, market researchers, sourcing experts. We had to research the competition, set an assortment framework, conceptualize the new brand and storyboards, and then selected factories that could execute specific costing, specific MOQs, specific quality standards that were required to make this project successful. And the outcome 10 months later, right, with a collaboratively developed solution was delivered. The internal core team at Department 56, they really had to spend their time just signing off on what the Sherpas had done, right? The market analysis, the brand and storyboards. So the internal team collaborated, but simply by signing off, by saying, yes, I agree, no, please change this, edit that. And the outcome was a turnkey solution with sample-ready specs and a factory matrix, minimal distraction from the core business, and a decent ROI, a decent return on investment. First year sales forecast was in, I can safely say, without breaking any confidentiality, it was in the low 6 figures, $1, $2, $3 million range. Might have been higher if they sold to key accounts. I don't think they did. And the project expenses were about 1/10 of that first year revenue goal. So they probably added money to the bottom line in the first year, but definitely in years 2, 3, and 4, because this project remained in line for a good many years. So that was one case study. Department 56 will go into, unless there are questions here, I'm watching the chat box, not seeing anything yet. So we'll go into the second case study. This was also a third growth option by adding a new adjacent category. This one was a longer term, a different team structure. We had, instead of 5 people for 10 months, there was 1 full-time Sherpa for the 3 years, and then couple more Sherpas were added on the client side a year into it, a couple more 2 and 3 years into it. This particular project went to a different retail channel. This was for national chains. And there was really a focus on turbo growing this new category in years 2 and 3. Very similar situation. So this was a lighting distributor that wanted to get into the furniture business. The 2 orange actually all the information in the orange boxes here, exact same situation as it was on the previous case study. Hit a growth ceiling. We had too many ideas, no bandwidth of the core team, couldn't spend time on this. Private equity pressures, etc. And again, you might have a situation where you're considering adding an adjacent category, maybe for different reasons, like I said earlier, tariffs, e-commerce, other things like that. So here's a list of the challenges that we were facing in this particular case study. Again, they had too many ideas that needed to be narrowed down. Pipeline visibility in terms of design pipeline, sales pipeline, inventory pipeline was difficult. Communicating with factories and buyers in multiple continents, multiple cities. But the last 2 challenges were particularly significant on this project. Just building the sales team's confidence with unfamiliar product, right? This is their core product is lighting. And here they're being asked, this lighting salesperson is being asked detailed technical questions about furniture that, you know, just required some product training on that new category to make it successful. And then creating momentum when you're going from 0 to something is of paramount concern. You need to create the momentum until the project is cash flow positive. If it's cash flow negative for too many months, people get itchy, and it's very, very important to think through creating the momentum. So here's what we did. Now, I thought this was kind of funny. We had a marketing intern earlier in the summer, and she came up with a slide that makes it's an absolutely correct description of what we had to do. We did have to establish a core assortment, nurture product idea flow, support sales presentations, drive vendor development, but it made it look so deceptively simple. But it's true. This is part. It is a good description of how we executed. This slide tells that same story, just a little more detailed. Again, first one, growth evaluation and research. For this particular project, we needed to break down the research in terms of in the US and then research in Asian factories. We started with a US research, really slicing and dicing the market by what retail channel, what national chains did we want to go after, which ones did we not want to go after, what consumer trends did we want to go after. There were consumer safety regulations in some of the categories that we had to spend a lot of time becoming familiar with. And then with that information, with documentation around the US market research that we wanted to, and the part of the market we wanted to focus on. With that research, we went to Asia. The Sherpa went 3 or 4 times a year the first couple of years, visiting factories, visiting showrooms, actually visiting some 70, 75 factories, as I recall. And then the third part of the category growth strategy here was quoting and sampling. In the first year, I think it was over 3,000 quotes. Some 500 samples needed to be brought in. The emphasis was less on design complexity, much more on process, more emphasis on quality process, quality specs, quoting to a price, or designing to a price point. And then the final step was the purchase, procurement, and sales support. So you can, it's easy to see how a full-time, how this could have been a full-time job, and then 2 or 3 or 4 full-time jobs as the business grew. So the third growth option does require resources to make it happen, and the reason for that is, that saying I said earlier, you cannot run a business and build a business at the same time with the same resources. So here just a couple of quick visuals of what it looked like. So the U.S. competitive research, ended up being very product-driven research. We had 1, 2, 3, 4 different product categories that we were looking at. And then the columns here are the price points at, I don't know, a dozen different retailers. Ended up being, 50 or 100 pages worth of competitive research for these 15 retailers. Down here, factory research, again, with 70 or more factories that we narrowed down to then 7 vendors in the end. All of that together begot Assortment 1.0, which then required, as the business started taking off, required operational planning, Gantt charts, product development calendars, material research for very sort of minute, deep but important details of the product to make it more, reduce returns, improve quality, increase margins, et cetera, et cetera. So outcomes of this particular project, third growth option case study, a furniture business that went from $0 to $3 million in year 1, $10 million in year 2, and then $0 to $26 million by the third year. Pretty fun and fantastic outcome. They were also successes for the core business. So the second one, we expanded the sourcing base to then include India, Vietnam, and Indonesia. The lighting company, the lighting assortment ended up benefiting a little bit from the furniture sourcing into new countries. We improved the supply chain visibility, because we had to. Now we're dealing with 4 different countries. And the Sherpa really focusing on the supply chain visibility really helped drive the financial success of this particular project, because by the CFO would not have approved purchase orders that were needed to go from 3 to 10 to $26 million. We're talking 200-300% increases, which sort of have CFOs get a little jittery for good reason when you're asking them to approve purchase orders that are double and triple the 12-month ago period. But the supply chain visibility focus helped soothe those fears. And in the end, we ended up launching another a group of other Sherpa teams for this same company. And that Sherpa story became, the Sherpa growth story became an invaluable part of the sale process. The company was owned by private equity, and they ended up being sold to another private equity company, and this Sherpa growth story was part of the presentation to new suitors, new buyers, and it did increase the price of the business for that reason. Okay, I would love to, if anybody has questions, sometimes, now we're sort of coming towards the end of this webinar here. Maybe if, instead of typing something into the chat, if you want to just unmute yourself and just shout a question out, we can try that. So I'll just kind of see if somebody takes the bait here. Nope, nobody taking the bait for a question. Okay. Then let me give you just one sort of last little tidbit here. Three lessons I learned, and I call this VPAC for it's that middle column here: visibly prioritize, adapt, and collaborate. Visibly prioritizing is really about, prioritizing, then make it visible both in terms of the future vision, where you're trying to go, and in terms of the historic record, where, how did you do last month, last year? The fact that we did public milestones and really shared the foundation work in both the Jimco project and the Department 56 project really helped get buy-in across, really across the entire company, top, middle management, and everybody. It increased, this visible prioritization really drives accountability and efficiency. Adapting, I think, is some, it's the classic plan tight, but remain situational. And, I alluded to 1,000 deaths that any of these projects can die, especially if you don't get the momentum going in the right way. On the Jimco project, there was a situation where, we had planned to go after 2 specific categories in furniture, but then people thought, well, why don't we test this one and test that one? So we did test a bunch of others, which, yes, that was a slight distraction, those tests, but they really nurtured the continued buy-in, and that really helped. On the Department 56 project, we had, there was a new division president that came in mid-project, and that required adapting because things that had been agreed to by the prior president were seen differently by the new president coming in. That happens all the time, and the way we got to the finish line was just to adapt and keep our eye on the prize, and that's important, right? And I think on the collaboration piece, I always talk about the idea, or the value of the idea is more important than the author, the person who authored it. Having really open and honest and direct conversations around topics helps with collaboration. Having very public milestones helps with collaboration because everybody feels like, okay, this is a fair process. I know what's going on. A little bit more context around these 3 lessons are on the blog from June. I gave you the date there in the upper right-hand corner, so you can look that up on realignforresults.com/blog. We've got, please block your calendars. We've got webinar 3 where we'll go through new channel case studies coming up September 19. And then the final webinar of this series will be early November, where we'll go through core business new go-to-market case studies that have created over $40 million in new revenues. So looking forward to the next 2 webinars. We will publish a recording of this webinar with your permission, I'll send you a link to the recording in a couple days. In the meantime, I would like to invite any of the participants of this IMC-sponsored webinar to schedule a phone or video call to discuss growth options that you have, growth ideas that you might have for your business. Love to listen to them and see if we can help you think about those in a way that they can be executed and really add incredible value to your business. So with that, I don't see any questions in the chat box right now. So we'll sign off here. We'll send you a link in the next couple days. Thank you so much. Cheers, everyone.